people on the call that don't know you, either because they work in my sphere under our chain of command and they're kind of newer to the coaching, or they're trial members that just signed up for our coaching. So why don't you tell us real quick where you're coming from?
Yeah, so 17 years in the mortgage business as a loan officer, branch manager, brokerage owner, area manager, recruiter, producer, originator, all that stuff. I'm a best-selling author. I interviewed a best-selling author yesterday, Hal Elrod,
Nice.
who, listen to this, Scott, sold over 600,000 books so far. I, on the other hand, have sold about 600 books, but I'm catching up. But yeah, in all seriousness, mortgage guy, author, very, very much into personal growth and business development, been coaching for many years, known the lovely Scott Groves for many years, and hopefully
all the way I've been described, lovely is not really one of them. But anyway, okay, I got 3 people that want to get on right away on the link. So Mike, I don't like talking about myself. Why don't you introduce me without lying?
Sure. So everybody knows who you are. I don't know that you need an introduction, but Scott is let's see, let me write a bio on the spot. Scott is a top 1% nationally recognized loan officer and manager. Scott currently produces over $100 million of personal production.
That's a lie, 99.8.
Whatever. Manages an office with, I'm making up a number, $250 million of production, and manages a region that's going to what? $1 billion, $2 billion, $10 billion? What's the region look like?
Last year, the region that Justin and I are super blessed to help manage now, this is a new thing, did about 800 million, and our stated goal this year is $1 billion, and we've got a couple recruits that are coming on, and I think we're gonna get to $1 billion, and we have a big, hairy, audacious goal of getting to $2 billion in our region by 2020. So
nice.
All right, cool. So today we're going to talk about the big hot topic item that everybody's dealing with: overcoming rate objections. And really, when the market's kind of stagnant, we don't get a lot of rate objections. When rates are dropping and Cash Call is advertising on every single radio channel that rates are 3%, and then there's the fine print. Or when rates are rising, and now we've got a pipeline of pre-approvals and clients who have been thinking about buying a house for 3 to 6 months, they're mentally conditioned to think that the rate's going to be 4. Now a very fair market rate is 4.5. You're just going to run into it where they want to shop around and they need to hear it from 5 or 10 people what's going on. So the first question I want to ask everybody on the call is, we want you to engage, we want you to be present. Is right now a bad time for you to be on the webinar? So if you could just type in the chat box at the bottom of the webinar, is right now a bad time for you to be on the webinar? If it is, we want to know about it. So, tell us no if you're okay, but if it's a bad time for you to be on the webinar, we need to know who we need to record this and get it out to. So let me know, is this a bad time for you to be on the webinar? And there's a point in me asking this question, by the way. So it's Mike, myself. We have a third coach we're going to bring in briefly because he's doing some very cool stuff in the rate space. But the truth is, and I want to first be a realist here, I probably lose, and my business partner, Justin, and our team captain back here, Raj, we probably lose like a solid deal or 2 deals a month to rate. It's going to happen. I don't want you to think that there is a silver bullet to solve every problem. We're going to go over a lot of tips, tactics, pre-framing, strategy, Hail Marys on how to save a majority of the deals where your clients are rate shopping. But just know that you're going to lose some deals. And frankly, that's why you need to be in our coaching program. That's why you need to be lead generating and prospecting and lead generating and prospecting and lead generating and prospecting and coaching and growing, because you've got to be at a spot where you can afford to lose a deal a month, 2 deals a month, 3 deals a month, and it not bankrupt your family. So Mike, talk about that a little bit, that, loss is going to happen.
Yeah, well, loss always happens, right? I mean, we talked about this on the call yesterday for those of you that were on it, but those that weren't, right? The regular cycle for most of us in this business, some of us have gotten through it, but we're usually in a vicious cycle of the up month, then a down month, the up month, and the down month, where we're constantly playing catch up. And as you may know or may not know, we'll find out for sure, is that in a rising rate environment, and a climate like we're heading into, like we've been in and heading into, it's going to be harder and harder to bounce back from that. And so I think that we wanted to give you some tools and tactics and techniques to stop losing so many deals, to overcome and mitigate some of these pricing objections and shopping objections, but also let you know how important coaching is now more than ever. In a market like this, I mean, Scott, I would go as far to say that if you're not closing 5 or 6 loans a month, that you may run the risk of being out of the business. And if you are closing 5 or 6 loans a month, that's going to drop down to 3 or 4 or 2 or 3. And it's going to be even twice as hard if you're already a person who's closing 6, 10, 15, 20, 40, whatever it is. It's going to be twice as hard, maybe 10x as hard to sustain that volume. And so being involved in a learning community, being involved in coaching, having a group of loan officers from all around the country with different perspectives and coaches and content to lean into is going to make a huge difference on whether or not you stay in this vicious cycle of the up and down and that gets worse, or you create a virtuous cycle for yourself where you're constantly growing, plateauing, growing, plateauing.
I want to give you 2 tips on that, and good information, Mike. That's the challenge and the solution, right? The challenge is we're in one of those environments where it's going to be a little bit harder to do deals. The solution is to, as always, lead generate, prospect, grow, get coaching, take the coaching and then integrate it into your business. But I want to share 2 thoughts with you. That's the challenge into the solution. The mindset should be embrace the challenge. Embrace the fact that it's harder. The #1 producer in the country for 10 years, my business partner, Justin, used to work with him in the same office. His name is Mark Cohen. He's got all his own flaws and problems as a loan originator, just like the rest of us do. But he would always stand up at office meetings, and I've heard this firsthand from Justin, and say, great, make it fucking harder. Make it fucking harder. Very brutal guy. And his thought was every time they make it harder, every time TRID comes out with a new problem, RESPA comes out with a new problem, the rates go up, the market gets harder. The people that survive come out the other end stronger, more business, more market share, and that's just the way it is. So right now, if you feel like things are challenging, if you're getting beat up by clients, if things are sucking a little bit, embrace it. And your mindset needs to be, great, make it harder, because we want all the people that are doing 1 loan a month, 2 loans a month, 3 loans a month, and are not willing to grow and are not willing to embrace the suck. We want them to filter out of the industry, because in 12 or 24 months, we're going to be in a better spot and we're going to gobble up that business because it's still going to be there. So just some mindset stuff. And then 1 quick tip, two quick tips. If you notice, I'm always looking down, taking notes, always handwritten notes. And that's why I asked if this is a bad time for you to be on the call. Wherever you're at, take some notes. I've got books and books and books of moleskin journals that I have never gone back and looked at or read, but just in the moment of getting some wisdom and getting coaching, when I sit down and take notes, I've got an outline of what we're going to talk about today. I'm going to take notes every time Mike's talking, because just the act of taking notes will help you memorize, process, retain stuff. So take some notes. That's #1. #2, don't jump on Amazon right now because I want you to be engaged, but I want you to write down the name of this book. Never Split the Difference by Chris Voss. Never Split the Difference by Chris Voss. It is the best negotiating sales tactics books I have ever read. Chris Voss was a head of the FBI negotiating team for terrorism when people took hostages. He wrote a great business book on how to use those principles to negotiate. Absolute must read, reread it, get it on Audible and re-listen to it. It's phenomenal. And I'll just give you 1 quick anecdotal example of why this idea of just trying to get to a yes or split the difference or win-win, all of these theories are effectively bullshit. And the best example he gives in the book is he says, okay, husband and wife are getting ready to go out to dinner. Husband wants to wear brown shoes with his black suit. And the wife says, no, hon, you'd really look better with black shoes. And the husband says, no, it's more fashionable, wear brown shoes. So they get in a big fight. They decide to split the difference. And the husband wears 1 brown shoe and 1 black shoe. So in theory, they should both win, but guess what? They both look like idiots, feel like idiots, and both feel like they lost the argument because now the husband just looks like a moron with one brown shoe and one black shoe. So this idea of splitting the difference or a win-win or making sure everybody feels good, there is a way to ethically and tactically win in business negotiations. And this book is a must read, must listen. I think I've read it or listened to it on Audible 4 different times. Okay. Let's go into pre-framing. I just threw up a bunch of information. Mike, give me a little something on the power of pre-framing.
Telling what's to come, right? Telling somebody what's going to come, and then allowing it to come and talking through it, pre-framing the argument. Why is that important? I mean, I think it's pretty inherent why it's important, because it builds trust, right? It presents you as an advocate. And when you can clearly articulate your value proposition, clearly articulate what it is that you're bringing to the table, give a prospect an idea of what they're going to see as they move forward in talking to you, in telling them that you understand they're going to be shopping, they're going to be talking to other professionals, giving them an idea of what's to come. Before providing them with options. And I have some other thoughts around what type of options to provide them to really differentiate yourself. But yeah, that pre-framing is essential to winning more deals, especially in a climate like this. Even in a great environment, the more we pre-frame, the more we paint a picture of how the client should be thinking, then the more apt we are to win that client over in the long run.
Yep. And I want to talk about 3 ways that we need to pre-frame as mortgage bankers. Everybody on this call is in the mortgage banking industry. I don't think we have any loan officers from banks, Chase, B of A, Wells, whatnot. So you've got to pre-frame yourself and your own mindset. You've got to pre-frame your referral partner or your realtor introduction. And then you've got to pre-frame the client, right? So what do I mean when I say pre-frame yourself? You have to know your value. Everybody that's on this call makes somewhere between 75, 80 bips and maybe up to 200, 250 bips if you're a broker or you're doing primarily government business. Compare that with somebody who's going to be a low-cost leader, cash call, the call center at New American Funding where I work, anybody who works at a bank. Those low-cost leaders are making somewhere between 15 and 35, 40 bips. If you're the best top producer at Chase and you're doing self-source business, you're making maybe 60 or 70 bips. Compare that to what we get paid as mortgage bankers, and you've got to pre-frame yourself. You've got to know thyself. You've got to know that the money that you're making is worth the value you're providing and the education that you provide. Because if not, if you don't know that about yourself, if you don't believe that in yourself, and you just keep coming to your management team with, oh, got beat by Wells Fargo again, they're 50 basis points lower, they're 70 basis points lower. No shit, because that's what you're making an LO comp. So if you don't pre-frame yourself, if you don't know what you're worth and what your value or the company that you work for brings to the table, then you're not going to win this argument with the client. You're not going to be able to pre-frame your referral sources and your client because you don't believe it. If you don't know the value that you're getting paid for, if you're not doing a better job at your craft, if you're not becoming more and can add more value to the transaction, then frankly, you should not be on our coaching program. You should go work for B of A and just be a ticket taker and price, be the low cost leader and make 30 or 40 bips. There's nothing wrong with that. There's a lot of people that have carved out a really great career. But if you think you're worth more, then you have to pre-frame that in your mind. Next is you have to pre-frame the realtor introduction. Talk to me a little bit about, Mike, how you have that conversation with your realtors and how you like to be introduced.
Yeah, well, with my top realtors that I know are going to listen to me and actually implement some of the stuff that I want them to implement, that are committed to working with me in a close relationship, I'll give them the talk tracks, right? I'll give them the scripts about how they should be introducing me, what type of information they should be presenting to the client when they are introducing me, and give them just a really quick elevator pitch so they don't have too much to think about. So I'm not getting them talking about or even stepping foot on that slippery slope of them bringing up interest rate with their buyer, right? But giving them enough to introduce me that's going to present me as somebody that they absolutely must talk to, even if they just got off the phone with Wells or Bank of America, or just got their, Rocket mortgage approval, that no matter what, they need to talk to me because there's a difference there. So absolutely pre-framing. Before you go into pre-framing the realtor, Scott, I just want to say one thing that I took a note on while you were going through, pre-framing yourself, or putting yourself in that mindset of what is your value that you're adding to the transaction. What's super important to understand is you've got to remove the desperation you got to remove the needing of the deal. You have to be willing to lose the deal, right? To articulate your value as clearly as possible, to use empathy in negotiating with the client to make sure that their best interest is really at heart, and be prepared, willing, and able to walk away from that deal without emotional attachment, because you don't need it, because there's more behind it. And that's why, I just want to reiterate, it's so important to be getting really clear on the value, because you're going to lose deals. And if you're not able to do that, and your desperation will shine through, and it's going to become a vicious cycle that causes you to lose every bit of business that you go for.
One of the key terms, and if you're taking notes, I want you to write this down, that Mike and I have talked a lot about, is it's very easy, because of the fact that, shame on us as loan officers, as mortgage companies, we've commoditized our own industry. So now that's what we have to fight against. And frankly, that's what realtors hear, right? They hear the rate, they hear the cash call ads, they see the Google banners on their Gmail. The term that Mike and I have talked a lot about is strategic advantage, strategic advantage, strategic advantage. Write that down and drill that into your realtors' heads. And what I mean by that is that when Mike's talking to his realtor about that elevator pitch of like, hey, Mr. and Mrs. Realtor, I realize rate's important, and we'll get to that. I'll address that. We're competitive, but I don't need you to talk to the client about rates or programs or anything like that. All I need you to do is drill it into the client's head that, hey, I don't care who you've talked to. You can work with whoever you want. Mike will take the Pepsi challenge against other lenders out there, but he is going to give you a strategic advantage to getting your offer accepted and helping you plan your financial future. Now, Mike and I both worked at a company where their secret sauce was being able to go very fast and clearing things to close in 7 days. Other people's secret sauce is they have a huge, swath of products. Other people's secret sauce is their education. Other people's secret sauce is their post-closing follow-up, and the fact that they basically take on the role of financial advisor before, during, and after the transaction. Whatever your angle is, whatever your niche is, whatever you do very well for your client, and you better be willing and ready to articulate that and then follow through with your realtor partners. That goes into a different training. Email us if you want the archived training on connecting with realtors and building relationships at appointments. But if you want to do that, if you want to grow your business, you better be able to talk about your strategic advantage and then have your realtors or referral partners talk to you or talk to people about you in that manner. So I've had a lot of conversations. I've fired some referral sources. I've told them that we can no longer work together because they wanted to take the easy road out and say, hey, call Scotty, he's a mortgage guy, he'll give you a great rate. Well, I don't know if I'm going to give you a great rate. Maybe you have shitty credit. Maybe your scenario is cash out on a non-owner occupied 4 unit, and your mindset of what a great rate is versus what the market level is with the loan level pricing adjustments. Maybe that's not a great rate in your mind. And now the realtor has completely blown the relationship prior to the introduction even happening. So, a lot of people want to know, well, what's my script when we're in escrow and somebody asks me about the rate being 4.75 instead of 4.5 because B of A is at 4.5 and I'm at 4.75. At that point, you've already lost the war, man. We'll give you some Hail Mary tips in about 20 minutes on how to maybe win that battle. But if you're not starting back at the beginning, pre-framing yourself, pre-framing the introduction, pre-framing how your realtors talk about you, yeah, you might get lucky and pull out a Steven Seagal move. Oh God, I just dated myself, and win that battle. But you've already lost the war. So I don't know how much more we can belabor this point. And I think you're on mute, Mike.
Yeah, Steven Seagal. Wow, I think that's an awfully slow move these days. Frankly, I don't know. Let me also make a distinction that and hopefully I feel it leaving my brain, so hopefully I can remember. But You talked about having a strategic advantage, having a niche, and that if you're at 4.75 and somebody else at 4.5, chances are you've already lost, right? I think it goes without saying, but I want to reiterate this anyway, that the best way to combat being higher in interest rate than another lender is to put more products on the table, to put strategic thinking on the table. The client's going to ask for a 30-year fixed or for a 5/1 ARM or for whatever it is they're interested in. But the way I've always won deals in the past when I wasn't the best on rate is by providing them options that somebody else didn't provide them. Being seen as an advocate and as a professional and saying, hey, you've never considered this. Here's 3 or 4 or maybe 5 other options. I know you're probably leaning 30 fixed. However, you might want to take a look at doing this. And that simple act, is it a Hail Mary tactic? Probably. But it's also a tactic that works and will definitely snag you at least a couple more deals and teach you a lot more in the meantime and give you a lot more value, especially if you don't have that niche or that specialty. You're just kind of a vanilla lender.
Cool. So we've talked about the pre-framing. We've talked about getting in the right state yourself as a professional, talking to those realtor referral partners. And by the way, this is a lifelong mission to re-educate your referral partners on how they need to introduce you, why the rate doesn't matter. My business partner, Justin, I remember almost seeing him jump out of the seat one time because we were knee deep in fighting for a transaction. And he just asked the realtor, he's like, hey, Mr. and Mrs. Realtor, what's the most important thing about the loan? And she goes, well, the rate, of course. He sprung out of his seat, almost yelling to the phone. He's like, no, it's not. It's closing the deal. You have a client who's foreign national, bank statement program, blah, 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 blah. The rate is insignificant if you can't close the deal, because if you can't close the deal, he doesn't get the house. Nobody gets paid. What are you joking? It was just amazing. I wish he was here so I give him a hard time. But all right, so let's talk about you actually get the incoming call from the client. And, I think this is important. If you find yourself getting rate shopped a lot, if you haven't streamlined your process, automated your process, if you're not getting the strongest realtor referrals, whatever is going wrong, if you find yourself getting rate shopped a lot, you need to take the time and go back to taking applications up front by phone. And I know for a lot of people that will sound foreign because that's what they do. But I know a lot of people, especially in Southern California, where everybody feels very tech powered and tech savvy and forward thinking, they're like, no, just send me the online application. I'll do it tonight in my pajamas or whatnot. And you've now missed an opportunity to do that pre-framing. You've missed an opportunity to build rapport. So if you find yourself getting rate shopped in excessive amount, and if you're not taking the full application up front, then you need to go back to basics. And you need to realize that you've done something wrong in your funnel, in your digital presentation, and the way you're getting referred. And you need to go back to basics and take those applications. Here in my neighborhood, there's a guy that's about a 35-year veteran of the industry. He is very tech savvy, but the one thing he does, his name is Rob Levy. You should look him up. He's a great loan officer. One of the things that he still does is he takes every application by hand. And he's like, Scott, I've been doing this for 35 years. I can basically take a full 1003 in 5 minutes. And he says, I have 3 talking points when I take the 1003, because rate always comes up. He says, the first thing I say is when the rate comes up, he stops, he gives a dramatic pause, and he says, look, if you're getting ready to make a mortgage decision based off of who has the lowest rate, you are about to make the biggest regrettable decision of your life, because somebody that doesn't know what they're doing is going to quote you the lowest rate to get your business, and you will be lost. The transaction will fall apart. You won't get what you were promised. Very dramatic. This is what can go wrong if you go with the low-cost leader. If that's not enough, he says, as he goes through the application, he's like, okay, any car loans, da-da-da-da. And they, most people in America have a car loan. And he says, cool, what's your interest rate on the car loan? Always, again, dramatic pause. And he uses this opportunity to tell the client, hey, look, I'm taking 20 minutes of your time to help you buy a $500,000 asset. I'm guessing you spent 9 hours at the car dealership buying a $25,000 asset, which is really a depreciating asset. So it's not even really an asset. And after that 9 hours and after fighting and haggling and whatnot, You mean you can't tell me the interest rate on that car loan? I challenge anybody without looking at their banking account right now. Tell me what the interest rate is on your car loan. And if you're right, I will send you a crisp $100 bill because you're wrong. Nobody knows what the interest rate
3.75%.
Mike, I give you a lot more than $100 bills. Nobody knows what their car loan is, right? But everybody knows that their payment is $352 a month because that's what they write the check out for. They see the automatic payment go out. So he uses this as an opportunity to tell the client, look, the interest rate doesn't matter. Just like you sat there and haggled and fought and whatnot, what matters is your payment. So let's focus on the payment, just like you focus every month on the payment of your car loan. Let's set you up on a plan and trajectory to be a homeowner. And I promise you the rate might fluctuate from day to day, but your payment is going to be in a range that you can afford and you're not going to lose your house like so many people did in 2009. He said right there, the dramatic pause about making the biggest mistake of your life if you're just thinking about rate, plus the car example, 90% of people never ask him about the rate again, and they just take his word for it through the entire transaction that he's watching out for him because he is. He's a good guy. He's a good loan officer. And then third, if the rate conversation comes up again at anywhere between that car example and getting the file fully pre-approved, which means he's gotten paperwork, if they ask him again about the rate, he goes back to those two examples and says, frankly, I just don't think we're the right people to be working together. You should probably find an online lender that can quote you a low rate. And again, that willingness to lose the deal solidifies it in the client's mind that, oh my God, this guy is so serious. He'd rather not get the business than work with somebody who's acting obnoxiously over the rate. So I think this is the first time, because I learned all of this about 2 months ago when I had dinner with the guy, Mike. I think this is probably the first time you've heard these examples from me. How are they landing with you? Are they resonating well? Are they bogus? What are you thinking?
No, I think they're awesome. I just took some notes on this because I haven't heard you say this before, and I actually haven't considered this. I love the lead on, hey, this is what could happen working with a low-cost leader. Finding a way to say that without disparaging another company, I think, is important, right? You don't want to come off as disparaging the competition, of course. The car example is awesome. Are you going to have some people that tell you, yeah, I know the rate of my car, it's this, and this is my payment, and this is how long it took? Like, sure, I could actually do that, Scott. I'm sure a number of people could, but I think you're right that the vast majority won't. Right. The vast majority, you're on mute, but the vast majority won't. And so playing the numbers game and the law of averages makes sense. And here's where the law of averages really plays into this, right? We keep talking about being willing to lose deals. You have to be able and willing to lose deals. The best way to overcome rate shoppers is to not need the deal in the first place, right? And so if you're operating on the law of averages, if you're operating by saying, hey, I know that I need to make X amount of calls to have Y amount of meetings, to have Z amount of applications, to close, B amount of loans, and you've got some fallout rates in there, you've got some conversion rates in there, you've got all of those rates built into this equation. So you could take it down to how many phone calls do I need to make, right? All you need to do in this rising rate environment is understand you're going to lose a lot more deals than you used to, adjust those averages in your equations, and you've got to make more calls, because that's the only way that you're going to be able to afford to lose more deals. There's no magic to this, Scott. It's just fucking working harder. Pardon my language. It's hard work. It's all it is, right? There's no, yeah, sure, there's little tactics and tricks and techniques and Hail Marys, like you say, but at the end of the day, it really comes down to you have to work harder, and you have to work smarter, and you have to learn new skills and be involved in a community of support and accountability where you're learning the mindsets, the skill sets, and an environment to grow in order to afford to lose those deals.
There's two other things that I want to go to real quick on if for whatever reason the car example doesn't resonate with you, you need some extra ammunition. There's two talking points when I was in a mode where we were taking every application online because the market was crazy about 2 years ago, 15, 20 offers per house. We're doing a ton of cross qualifications. So I was pushing everybody to the online application. And I want to give you two more talking points that I would use knowing I only had a 5 or 10 minute window to hook these people and get them to go to the online application and send all the paperwork, then the danger is their next phone calls are like, oh, let me just make one more phone call is to Mike. Mike takes the application over the phone, gives them some rate quotes, and now I never hear from them again. So let me give you 2 talking points. One of them was my favorite, and it might just be because I'm a blackjack degenerate, but I would always tell clients when the rate conversation came up in that pre-approval stage and that intake and that application, and they said, hey, what's your rate? What's your rate? I'd say, look, I would always close for the application, right? I would say the rate's going to be somewhere between 3% and 5%, depending on your credit, depending on what type of deal you want, depending on how much down. Anybody who is giving you a rate quote over the phone without having all of your application, information, documentation is gambling with your financial well-being. Gambling with your financial well-being, gambling with your financial well-being. Write that down. When you tell somebody, when you, again, pre-frame the conversation that what I'm doing is a value add, is a service, is a deep dive into your finances, and the rate will be a byproduct of that work, you are the subject matter expert, whether they know it or not. But you can really bring it home by saying, hey, anything you hear on the radio, if you decide to pick up the phone and call 7 more people today and get a rate quote, and they're doing that without all of your information and knowing all the details of the deal and reviewing your tax return, which is what I'm going to have you do when we get off this call, Mr. and Mrs. Client. I'll give you the link to my online application. I'll give you a list of documentation we need. Anybody who's not doing that, they are gambling with your financial future because they're guessing on an interest rate. They're guessing on what's going on with your financial picture. And frankly, that's not somebody you want to work with. That was talking point number 1. And then I would also start to pre-frame just in case disclosures accidentally got triggered when they filled out the online application because they put in a property address, or just in case I couldn't get to them fast enough when they went into escrow or under contract before the disclosures get out. I start to pre-frame this idea of don't freak out once we get into escrow or under contract, because the rate I give you today, the rate I give you tomorrow when we're running scenarios, and the rate, frankly, that I give you on the day that we go under contract and we have an accepted offer, I'm going to estimate on the high side. So the last thing that I want to do, Mr. and Mrs. Client, is set you up for failure. I don't want to quote you the rock bottom rate today, which a lot of people were doing 6 months ago, and quote you 4%. And then by the time you get into escrow in March of 2018, the market's gone up a half or 5/8 or 3/4. And now I've set you up for failure because the houses are a little bit more expensive, the rate's a little bit higher, and now your expectation of what you could afford is completely blown out of the water. We might be starting over. So today, tomorrow, and the day that we disclose your interest rate when you get under contract, we're going to estimate a little bit high, but don't freak out. My job is to keep an eye on the market for you and find a great day to lock you in. And if you do that on every initial conversation, I promise you, you will cut down on 50% of the headache once you actually get into contract. So again, all of this is building on itself. All of this is creating a good client experience that ends up with you not having to have a fight over rates. So how's that land with you, Mike?
Yeah, not only having that conversation on the front end, Scott, but also having a script ready that's like a 45-second to 2.5 minute, somewhere in there, bomb video or text video or email video, something that you can send to every single client in the process, every single pre-approval process, that says, hey, this is my script around interest rate. I know you're talking to other people right now. Here's what you need to watch out for. Here's what I do. So yeah, have that conversation on the front end. Also have a script written where you can just deliver it by email, bomb, whatever you're using, to each individual client, personalized. That'll go a long way.
Yep, I agree. A good question here from Sam Beckett. Do you know if that LO I mentioned, the one that gives the car example, will he give pre-approvals to a client if they have not supplied all their information up front? Absolutely not. No pre-approval letter goes out until he's seen all the paperwork, has the credit, has the application. That's just how he does business. Now, of course, there's exceptions to every rule. Repeat clients, sometimes you can talk to somebody and just get a feel for the fact that they are highly qualified. Maybe you'll send out a pre-approval letter without having everything. This is a little ninja trick that we use in our office. We use the word accommodation. And what we do is if we send out a pre-approval letter, knowing in our heart of hearts that we don't have all the data to make an absolute correct decision, we tell the buyer's agent who bought us the referral, we tell everybody internally, and it goes out in the subject line of our email. So it's a little, bat signal to everybody in the office. Hey, we're doing this pre-approval letter as an accommodation. We're still pending this and this and this and this and this, and you better have a loan contingency. This isn't one of those deals where you can remove your loan contingency or your due diligence. So have a code word in your office for when you do make exceptions to the rule, Sam. That's just a little ninja tip. Okay, so let's talk about at the disclosure stage. So now the client's gone into escrow. They're super excited. They're under contract. They're in escrow, depending on where you're at geographically. And let me just talk real quickly to the 20 out of 37 people who are on the call in the Southern California market. And I try not to be geographically biased here, but I'm going to be for a minute. The market right now in Southern California is just batshit crazy. Neighborhoods that you would not be buying a home in as a family 10 years ago are now going $50,000, $100,000, $150,000 over asking, and it's totally normal. It's just par for the course. And from a loan officer standpoint, from a uninterested party who's just looking at the mathematics of it, it makes my blood pressure go up. Like, I'm literally on blood pressure medicine. It makes my blood pressure go up because the client will simultaneously let the realtor sell them on the idea that paying $150,000 over asking for an 800 square foot bungalow is a great idea, but the client wrapping their head around paying an extra $25 a month because the interest rate with me is an eighth higher than the next guy, even though they know that we've been there since the beginning, it's not congruent, but it's what they're feeling. So, if I just overpaid $150,000 for an asset that I'm not quite sure is worth it or not, I would be looking for any way, shape, or form to get a win. Justin just almost lost a deal the other day, and we have found as partners, when he's about to lose a deal, I'll jump in and make the phone call. When I'm about to lose a deal, he'll jump in and make the phone call. Because when you're not emotionally attached to that client or that realtor or that deal, sometimes you can do a much better job salvaging the relationship. So there's been a bunch of times where I've turned to him or Arash and said, hey man, you got to make this call for me. This is not going to go well if I take the call, and vice versa. This one just happened to be, I took the call for Justin. And in talking to the client, he was about to go start down the path with another lender. It wasn't about their interest rate. It wasn't about our lack of service. It wasn't about the fact that, Justin talked to him when he was tired because he's got a newborn. It was the fact that he just got beat up buying a house. He's paying $70,000 over asking, and he needed a win. He really, really needed a win. So what I thought was an interest rate objection was really this guy's emotional, plea for help. Give me a little something, man. Let me get a little reprieve in this situation, and a $500 credit to pay for his appraisal at closing. So we're not giving him that money up front. We are giving him a slightly higher interest rate than what the competitor was going to give him the day we went into escrow. But for $500, the problem is gone. He's moving forward. The appraisal is ordered, and he's super happy. It's gone from these guys are trying to screw me in his conversation to the realtor to, man, they really took care of us. Good guys. Thanks for a friend. For $500. If you have a problem that can go away for $500, you don't have a problem. You're just complaining. So make the problem go away for $500. Try to get a win for the client. But at the disclosure stage, when somebody goes under contract, Mike, talk us through a little bit the conversation you have right when you go into contract.
Well, a lot of that conversation I'm trying to have up front. And so I'm reiterating a lot of the things that I said. I send out a bomb video where basically walking people through the disclosures and again, talking about the interest rate. Chances are we're floating, right? And so talking about why the interest rate reads the way that it does on the initial disclosures. But also, Scott, I spend a lot of time talking to the realtors because you mentioned, especially, it's not quite as bad out here in Charleston, but I think it's very similar all over the country that, you got a guy paying $150 over asking for a bungalow. It's definitely nowhere near that, but still a guy who, the realtor is putting a client into a property that's well over asking. Realtor needs to find a way to position themselves as an advocate and a value for that buyer, right? So there's two ways the realtor can do that. There's many ways, but two ways in relation to the loan officer. One way is they can be an advocate for their client by protecting them against the loan officer. And the other way is they can be an advocate for their client by saying, I am a partner of the loan officer. He is me, I am him, right? And so the communications, the scripting, the talk tracks, and the pre-framing that goes into those realtor relationships and realtor conversations from pre-approval up to contract and beyond, super important. So the realtor flips that switch and decides, hey, I don't have to present myself as protecting my client from the realtor. It's far better for me to present myself as a partner with the lender. And I think that's hugely, hugely important. But yeah, it's constantly repeating everything that you've already said, because buyers aren't listening. They're not retaining. We tell them things one time, two times, three times. It goes in one ear and out the other. Chances are, if you're like most loan officers, you're using jargon that they don't even understand, and you're really not clearly articulating things verbally, in writing, and on video. Verbally, in writing, and on video, over and over and over, 3 to 5 times for each point that you want to convey, both to the buyer and to the real estate agent.
Absolutely. You said something there that I really like, which is the advocate. Again, that gentleman who we gave the $500 to, what he wanted to hear is that we weren't bad-mouthing the competition. We weren't competing against him and the competition for the deal in the interest rate. We were his advocate. And when I could say, hey, man, like, you just had a kid, Justin just had a kid, he just wants to help another family get into a house, man. He's going to be an advocate for you. And oh, by the way, we know you just paid over $70,000 more than asking for this house. If the appraisal comes in, we're going to be an advocate for you because we know the listing agent. We know the listing agent very well. The listing agent trusts our local pool of appraisers. We can go back and be an advocate for you and be like, hey, man, let's split the difference. Let's get the client a little something. And I said, when it's all said and done, if we can help you get a $5,000 closing cost credit applied, if we can help you get a small token price reduction, if we can help you negotiate the deal, that value is worth so much more than the $39 a month that you'll pay for 5 or 6 years until you refinance this house. Be an advocate, position yourself as the superhero and the partner of the client. Let them know that you're going to work on their behalf. And a lot of the rate conversation goes away. Now, we had a question from the audience. Why are you floating at disclosure time? Is it to feel them out to see if they will accept the rate that you're selling? I always float the rate up front. And it's because the script that I've developed has always been, from the staging with the realtor, the pre-framing with the client, the application, my script has always been, hey, everything's going to be over disclosed, a little bit inflated, worst case scenario, a little bit higher than what I think we'll be able to lock in at. So that just plays into how I'm pre-framing and scripting things up front. And then we go into escrow. I tell them again, hey, we're floating your rate. I'm going to keep an eye on the market for you the next couple days. The most important thing is let's not get fixated on the rate. Let's order the appraisal and move the deal forward. That's how I've built my scripts and my plan and my workflow. Now, there's a lender down in Orange County who I know very well, Brenda the lender. Love her to death. She has a totally different methodology. Her whole scripting from the original introduction from the realtor, the pre-approval, the in escrow is, she is big about talking about the plan. We're following the plan. We're following the plan, the payment plan, the payment plan. Her pre-scripting all revolves around, I'm so honest, upfront, and thorough. We're going to have a plan. We're going to execute on the plan. The day you go into escrow, we've got our plan. We're locking the rate. We're following through on the plan. So it doesn't really matter which way you go. I'm a little bit more biased towards floating because that's just how I've built my career. But if you're the type of person that likes to lock up front on day one, set it and forget it, I think the risk is you open yourself to being a hedge. Great, I'm locked in with Scott. Now I can go shop around and see if there's anything better for the next couple of days. That's my fear. That's my limiting belief because of how I've scaled my business. For Brenda the lender, she has no fear around that because she has systematized the plan. And when the client goes into escrow, there's no more fear. There's no more stress. There's no more rate shopping because they're like, yep, followed the plan, use the plan to get my offer accepted and buy my house. Now I've got my plan. I know what my payment is. Awesome. I'm moving forward. So no wrong way to do it. just make sure that you are creating a congruent sales funnel as you go through all these steps. Because if you're selling the plan, you're selling the plan, you're selling the plan, and then you say, well, let's float the rate and we'll see what happens. Well, holy shit, that wasn't part of the plan. So just make sure that you're building your sales system however you want it to be.
Yeah, and Scott, Michael Allman just commented that in this market that's a little bit nutty to float, and I tend to agree, Michael. We haven't been in a rising rate environment for quite some time. A true rise. I mean, we have, right? Little microcosms of rising rate environments, but a true rising rate environment like what it feels like we're in now and what we've been experiencing. It's been quite a while since I've operated in that, and so perhaps it is time to take another look at that strategy of floating versus locking. But typically it's got a lot to do with, I'm trying to execute a 20-day lock, or I'm trying to do something like that to be competitive. And so I'm typically floating disclosures. But yeah, well put, Scott. Scott, I don't know if you've got much more to add, but I know we've got Ron Sequeira on the line.
Yeah,
I'd love to hear from him soon.
If you can bring him in on his video, I want to give one more talking point here. Whether or not you are locking upfront, which I think is a fine tactic in this environment, rising interest rate environment, or whether or not you're deferring that conversation for a week or even 2 weeks if it's a longer escrow, you need to give the client, and I will argue this to the death, 3 options when they lock in. So, interest rate option, payment option, credit option, cost option. And what I mean by this is back in the day when I used to only quote run rate, hey, here's the par rate, here's the rate me and my company and everybody will be happy with profitability and locking. The client would immediately take that rate and be like, sweet, I got Scott Groves' rate. Now let me look on bankrate.com, or let me call Natalie Salins, or let me call my B of A guy because these are other well-known people in our area. And the problem is that was my fault. I was only giving them one option. So now, whether or not we want to lock up front because the client's comfortable with the payment, or we want to float and lock down the line, I am always giving the client the par pricing. I am always giving them the pricing at, for us, it's 99 in Optimal Blue where the client pays 1 point. And then I'm always giving them the pricing at 101 in Optimal Blue where they get a 1 point rebate. And what I have found is when I lay that out in an email or a conversation and say, here's what you get if you pay money, here's what you get for free, here's what you get if you want a little bit of free money from the lender to help go towards your closing costs, putting that in a 3 bullet point email, the client, and this is some crazy Jedi mind trick, the client will immediately fixate on the 3 options that you have given them, which who cares what direction they go, because at the end of the day, all 3 of those are effectively par pricing. Whether you give them a point, they pay a point, or you go par, all of them are par pricing for you, your branch, your company. They are profitable, but they give the client options. And like I said, when a client's overpaying $7,000 or $70,000 for a house, they want options. They want that sense of control. They want to feel like they can get a win. And even if you and I disagree, if they feel like the win is paying 1 point and get a lower rate, or if they feel like the win is taking the higher interest rate and getting a free $4,000 or $5,000 towards closing costs, let them get the win. Let them decide what they want. Let them scrutinize those 3 options, because if not, the options they're going to look at is calling the lender next door. So I would love if Ron can we'll bring him on video here in a second, if Ron could bring up a scenario in his Optimal Blue, because I want him to go into how he's adding value, pre-framing, and then when the client wants to talk about rate, what he's doing in Optimal Blue. This is high risk, high reward, because that's how I roll. So let's make sure Ron's on video. Ron, if you can make sure you're on video.
Yeah, we're live, buddy. We're live.
So Ron, talk a little bit, some of this for everybody that does not know Ron. He's a loan officer in our branch who's almost tripled his business in the last 2 years. His brother is a realtor, so Ron gets to go to a lot of cool seminars on flipping and real estate related. And you got some talking points from several realtor seminars that you attended. Tell us a little bit about kind of your talking points, your ideas, and then show us what you're doing in Optimal Blue. We got about 10 minutes. I want to close with you because I think you've got the best strategy of keeping people engaged during escrow when they start to freak out about interest rates.
Yeah, no, of course. I think, the main thing is just building trust, The client has to trust you to try to avoid the shopping. I try not to get on the rate conversation. I try to put that off. And, what I like to chime in with just to kind of alleviate any concerns with the rate is, I always point out that, we're a volume operation, right? And because we do the amount of volume that we do, we're able to, shave a little bit off the rate sheet. So I leverage my PEs that way. People don't like to pay retail. They don't like to feel like they're paying retail. So by, allowing them to look behind the curtain, that's how I leverage Optimal Blue. So, it's funny. I had an old business partner. He wasn't really a fan of that. We just kind of had different styles, but I'll tell you, knock on wood, I have had very, very little fallout due to rate or rate shopping. And a lot of it is, I treat it very much as a consultative approach, and I let my clients know. I'll say, hey, look, you know what? You're in the driver's seat. I'm just showing you the way. So what I'll do is I'll take a snapshot of Optimal Blue, right? So I'll pull up my pricing. I'll get all the different rate options. And I explain to them, I said, look, here are all the rates, right? You pick it, let me know what you want. And you can look at the column over, that's the price to the rate. So by educating them that way and having them understand, and I point out, look, man, there's just a price to money. None of us can afford to be more expensive than the next guy. So it's all about who's going to deliver success, just to alleviate any concerns that they are paying retail or maybe paying too much or paying a premium. I say, look, because of the amount of volume that we do, I get to shave a little bit off the rate sheet for you, the friends and family deal. That's what we get for doing more business, and that's why we rely on your referral business. So that normally gives me a little bit of an edge that way, and they don't question it. Once I've explained it, they it's never really an issue at that point.
So do me a favor. I'm going to talk a little bit about what you do while you bring up Optimal Blue and share your screen. As a manager, when Ron comes to me with a pricing exception request and says, hey, I got to shave, a quarter on pricing or an eighth on rate or a quarter on rate or half on a PE or whatever the case may be, he has showed me what he's doing to win the day with the client. And I know it's not just, I don't really feel comfortable having a conversation about rate, nor do I, want to always give the client the best rate, nor do I just want to make my life easier. I am strategically using the pricing exceptions to win the day when the client is freaking out in the middle of escrow and is going to start shopping, or God forbid, let the deal fall apart over the rate and then the realtor is mad at me. So while he's bringing up a deal on Optimal Blue, and he'll show you how he talks through the client on this, because I know he shares his screen with the client or sends them screenshots. This is a powerful tool. If you're a loan officer and you're having some pricing challenges, sit down with your management team and have the conversation. Have the conversation about, here's where I'm getting the pressure. Here's the products where I'm getting pushback. Do me a favor, Mr. and Mrs. Manager, sit through a sales call with me on the phone, just be a fly on the wall to understand what the clients are dealing with. Because, unless you have a management team who is still producing, which is fairly rare in our industry, they're a lot of times not going to know what type of pushback you're getting. So, use pricing exceptions wisely. Don't always try to give away the bank. And then if you're having problems getting pricing exceptions approved, go through this demonstration like Ron did with me. And now, frankly, I don't really question his pricing exceptions because he's doing the right thing. So, Ron, I just unmuted you. Talk through a little bit. You're here on Optimal Blue, $600,000 loan amount, which is a high balance product in, there's my alarm. We got 5 minutes. High balance product in our market, and you'll just show the client Optimal Blue. So I'm a client, I'm getting a $800,000 purchase price with 25% down. I feel like maybe you're trying to pull the wool over my eyes because you're giving me 4 3/8, and I heard B of A could give me 4 1/4, whatever the case may be. Walk me through how you're using Optimal Blue in order to win the day.
Yeah, there's can you guys see the screen? Am I sharing it right?
Yes, we can see it.
Okay, wonderful. So a couple of things that I do here, and I put these parameters in just to kind of show two different approaches or ways of leveraging Optimal Blue. So obviously this is bringing up some high balance stuff as well as some jumbo stuff. This allows me just to kind of show them if you guys are in an environment or with a company that offers maybe multiple investor options for jumbo, it allows me to show the client like, hey, look, we have access to these warehouse lines. Like, so I'm doing the shopping for you, right? And just visually what this looks like to a client, I'm like, look, we got One West, Wells Fargo, Chase. Are they really going to go to all these places? It takes a lot of time to actually shop and go through and try to get somebody to give you a quote and apply. So just by showing them this, I think right off the bat, it just creates a little bit of trust and ease of knowing, hey man, you know what? This guy can shop this thing around for me. So it's nice. You give them, the proof that you've got options that you can choose from. Now, the way that I actually get down into the rate, and speaking more to your point earlier, Scott, about showing them options and educating them at the same time. So I'll actually go through the pricing with them. And let me do something that doesn't have weird pricing.
Ron, while you're looking for that, I just wanted to also say that just a client looking at this looks like super complicated. And so it paints you as a professional that knows a heck of a lot more than they know, just by, taking a quick glance at this, and then once you dive into it, totally love the transparent approach, man.
Awesome. Thank you. And then I point out, for instance, I got Chase Jumbo 10-1 here, but I mean, the concept is the same regardless of what you pull up. Once we actually identify like the loan program that might be the best fit for them, whether they're going to go fixed or an ARM, at this point, what's nice is, and I love the fact that it will show you like this 3% rate at 6.375 points, and I'm like, look, you want the 3% rate? We've got it for you. That's just the price for it today.
Yeah, just pay $38,000. Pay $38,000 up front and you'll get 3%. Cool. No problem.
Right. So allowing them to see this, and this is where I'll say, depending on what product I have, and what PE threshold I have, I try not to give away the bank, knowing that, hey, we might run into a situation where maybe we'll have to cover some of the client's extensions. I try being mindful of, how I present this to the client. So, I'll say, hey, look, this is normally what, somebody would get. You're seeing what I see when I'm actually reserving the money for you with these investors. So where I get a little bit of love for the volume I do, we can improve any of this by, like a quarter point. So at that point, I'll say, hey, you know what? Apply it anywhere that you want. If you want to take the 4% rate, you'll get that at 1.5 points instead of paying 1.75 of a point for it, So they're visually seeing that savings. They're knowing, they're seeing the retail price, right? And they're, you're showing them that you're giving them a little bit of love. So they feel, hey, you know what? This guy's going to take care of me for whatever benefit he might bring to the table of his production amount, whatnot, and volume. I'm not paying retail. And I think it kind of just eases those concerns and limits the shopping, man. Thankfully, it hasn't bitten me in the butt yet. And I'm hoping I'm not setting myself up to eat my words here.
Yeah, that's awesome, man. I'm going to share my screen here just because this might make a little bit more sense to people here. Can you see my screen there, Mike?
Yep, we got it.
Cool. So I'm going to revise my search here real quick. Let's do a $400,000 loan. Let's do a value of 420, and we'll get an FHA option up here real quick. FHA. And by the way, this is going to soon be a requirement of anybody asking for a rate quote in the Facebook group that you show your Optimal Blue pricing. So to Ron's point, if you can see here, I would probably lead somewhere between 4.25 and 4.625 because our company just kind of has created this culture of subsidies and pricing exceptions where I know to be really competitive in the government space, I need to lead with some subsidies if I'm at like 100 basis point comp plan. So I've started doing the same thing. I'll tell the client like, hey, the company would love us to price at 100. This is where retail is. I got that language from Ron. I know right off the bat, we can just take a quarter off the pricing here because we never want you as the client to play retail, and we do so much volume and we're so successful, we get that as a free option. But you know what? Because you're a preferred client, because we love the way that you were introduced and the fact that you were quick to get us all your paperwork back and we just want to do right by you, we can actually take 1 whole percentage point off the pricing and get you this 4.25. Can we just lock in now and be done with this? And a lot of times, again, I've started using this because of the discussions that I've seen Ron have, and it's a no-brainer. To your point, Mike, there's some visual representation here that makes us look like the experts, and they just say, oh my God, this is what I have to understand if I'm going to call around and do rate shopping. Yeah, Scott, thanks for doing me a favor and locking me in. Let's just be done. And by the way, Cole, I log into Optimal Blue every single day. It's encompassed that I really might not know my password. So this is an option, again, kind of high risk, high reward if you're going to start showing your Optimal Blue screens. But if something has gone wrong in the pre-framing, if something has gone wrong in the introduction, if something has gone wrong when you send out the disclosures, and now you're a week or two into the deal and you might lose the deal, then this is worth looking at with the client. And then the last thing I'll say is that you need to talk to your management team about how to manage pricing exceptions and profitability. And the thing that I have really, really fought against in my career as I've been a loan officer, a branch manager, and now a regional manager, we need to be looking at an industry as a loan officer or a branch or maybe even a region as a profit center, right? Bad things happen to companies that don't make money. But on a loan level deal, every loan does not have to be its own profit center. So, if Ron's doing 6, 7, 8, 10 deals a month, and one of them, he comes to me and he's like, hey man, misquoted, client's being a pain in the ass, I've got to save this one. Can I take a 1-point PE on an FHA? Can I take a 0.5-point pricing exception on a jumbo? We as managers need to look at that and say, look, Ron's put a lot of money in the pocket of the company, in the pocket of his management team. Let's take one for the team. Let him put, a little money in his client or a little money in his pocket. Take care of his client, take care of the realtor, grow that relationship, leverage that relationship with the realtor by telling him like, hey, we're taking it pretty hard on this one. The company's not going to be profitable. Management is waiving their compensation on this deal. We're really going deep for your client because we want to preserve the relationship. It's fine to do that on a deal when you're doing 6 or 7 or 8 or 10 deals because look, you've made the company profitable. You've made you profitable. You've made the client happy. It's when you're doing 1 or 2 deals a month and you want to take those deep pricing exceptions, well then the company has to look at you and say, we got to look at every individual loan as a profit center because the loan officer's not doing enough loans for us to evaluate them, the loan officer, as a profit center. So, whether it's through our coaching, doubling down on your efforts, prospecting more, get to the point where you're doing more deals so that you can go to management and say, look, this is my 10th deal of the month. You no longer need to look at that individual deal as a profit center. I'm making you money. I'm printing money for you. Let me go deep on this deal so I can get the 10th, 11th, 12th, 15th deal, which is going to lead to more realtor relationships. And if your managers aren't looking at things in that light, you need to have a serious sit-down conversation with them. Now, if you're doing 1 loan a month or 2 loans a month, you probably got to shut your mouth and be profitable on that loan. But just scale your business. Get to the point where you're at Ron's level, where you can come and ask for a pricing exception. And we're rarely going to say no because he's making everybody profitable. So anyway, anybody have any questions? I think that's the end of the formal training. As always, Mike and I will make ourselves available. Mike, we were going to stay under an hour. I claimed 45 minutes. We didn't do it. We're at 64 minutes. But
I took the over. I took the over on that.
I now owe you $200 because you knew your interest rate on your car, and we went over 1 hour. So
I'll make some of that Super Bowl money back.
I will have. Yeah. Oh, that's right.
Hey, listen, I just want to. I want to say something.
$100 bills for Mike Merriam next week at the live event.
Hey, listen, I just want to give a little bit of a plug, Scott, a shameless plug for Consolidated Coaching, because if you were on this call today and you hung out for the entire hour and more, hour plus, and you learned something, you gained some insight, you picked up a motivation, whatever it might be. This is just scratching the surface of what this community has been offering to each other. We are not a top-down coaching program where it's just me and Scott teaching. We've created a community. We've created a method to tap into the collective intelligence of loan officers all over the country. And so calls like this are just scratching the surface. If you want to be engaging with loan officers, learning their best tips and tricks and strategies, from all over the business, all over the country, weekly basis, having access to Scott and I's content of archive of coaching, which is launching very soon. By the way, if you're on this call, this is the first probably that you've heard of it. And Scott, I didn't even talk to you about this, but I'm going to throw a little teaser out there that in the next, 24, 48 hours, we've got a major release coming of our content archive. So you're going to want to stick around for that. But join us at Consolidated Coaching because honestly, even if it was a great market, even if rates were super low and there was tons of business out there like we've seen, you still need to get yourself into a place where your pipeline's at the point, your confidence is at the point, and your swagger is at the point where you're able to lose deals, walk away, live a stress-free life. And I think that's what we've built in this community, Scott. It's just this unbelievable crew of loan officers from all over the place helping each other be successful.
So I'm going to give a little teaser right here. This is going live prior to the live event. This is going to be the content management system, and don't worry about trying to copy down the URL because it's not live anymore. But we've got about 170 hours of coaching content categorized by topic, by guest coach. We've got a couple hundred PDFs, downloads, scripts. This will all be live within about the next week with whatever the most recent coaching is kind of highlighted at the top here, some little 60 seconds of wisdom scrolling down the right-hand side. And I am super proud of level 3 that we're now entering into in this coaching program because there's going to be a ton of material. Do me a favor. Mike and I aren't getting rich, nor do we want to get rich off of coaching. 95% of our income still comes from our loan origination business. So if you got some value out of the call today, if you could just go on the Facebook group and pimp what we're doing a little bit, give us a quick shout out, let them know that you got some value out of this coaching call. Let people know that they should at least check out the trial and or be on our monthly coaching. We're constantly trying to add value. Even though this isn't our big money maker, Mike and I, as I think you can tell, are really passionate about it. Because I want to see Ron fund $100 million next year or maybe this year. And, change his life, change his family. And the more that we can do that for more of you guys, it's just really fulfilling for us. So I'm going to leave it at that, man. Ron, thanks for guest appearing and giving us your optimal blue because 16 years I had never tried that and the shit works. So we'll see a lot of you next week at our live event, downtown Los Angeles, March 8th through the 10th.